Everybody talks about the PE ratio, how buying low PE stocks is key of making money. But here is the truth, it doesn't work the way most people think. Trust me, I've been there, I've bought a low PE stock, lost money. So in this video, I'm gonna show you everything from the basic definition to the advanced problem, and more importantly, I will tell you the right way to use the PE to actually profit. My name is Adri and I invest using multiples for more than 15 years. And in this video I'm going to share with you everything I know about the PE ratio, from the very basics to the advanced applications. We'll start with the definitions, problems, resources, statistics, and we will conclude on the more important part, what to look in order to make money with the PE. I've created timestamps, so you can feel free to jump around. However, I would not suggest you to skip the definition because it's given by the very pretty tennis player Anna Kurnikova. Check it out.
First of all, there's that whole language thing.
A PE ratio is price divided by earnings. Earnings per share is a company's net income minus preferred dividends.
Besides, some of the other players are kind of jealous of her, portfolio.
The PE ratio is price divided by earnings. But if you know nothing, you might ask, what's price and what's earnings? So it's simple, but the things to remember is that if we use the price of the share, then we must use the earnings per share. While if you use the price of the company, then we must use the earnings of the company. I know it's super basic, but let's be sure that everybody gets it. Let's make an example. Usually I go on Google Finance and I look for a company I like, let's say Coca-Cola, ticker KO, and you can immediately see that the price is $62.53. We should divide the price of the share by the earnings per share, EPS, $2.41, and we get PE ratio of 25.95. Alternatively, we can decide to take the price of the company, it's also called market cap, here, 269 billion, and we divide it by the earnings of the company that we find under financials, income statement, net income common stockholders, 10.4 billion. We divide the two and we get a PE ratio of 25.87, more or less the same. Easy, right? But let's go back to the ratio. The earnings in the denominator. What kind of earnings? Using different kind of earnings, we get the different variants of the PE ratio. For example, we can take the last officially reporting earnings of 2023, last year, 10.7 billion, or we can take the trailing 12 months earnings, the one that we took before, 10.4 billion, but we can even take the forward earnings, meaning the earnings of 2025. For this we have to go here in analysis, and we see that the average estimates of the analyst for 2025, it's $3. So we divide 62.53 again, divided by $3, and we get the forward PE of 20.84. My suggestion is to keep it simple and use the most popular trailing 12 months earning. It's also what is reported here in the summary page, and you don't even have to calculate it, you can just see it. And with this we covered the basics. The PE ratio is essentially a countdown clock of how many years of earning will take to repay the price of the shares, assuming the earnings remain constant. Naturally you would think lower PE is better, right? It means getting back your money faster. However, here is where things get tricky and there is a lot more to cover in order to make money with it. There are at least 3 basic problems. First, we need to be aware that the earnings might be extraordinarily high for some kind of special event. Imagine this, Coke decides to self-fund a brand for 50 billion. Suddenly, the earnings go from 10 billion this year to 60 billion, and the PE ratio drops below 5. It might look extremely cheap, it might look a bargain, but actually it would be a trap, because next year Coke will not have another Fanta to sell. Fanta. Second problem. Did you know that earnings are often the most manipulated data in the company reports? Accountants have like 100 different tricks, to tweak them, lowering them so they pay less taxes, or inflating them so they attract investors like you and me. And it's good to be aware of it, because if we invest, especially in small company, only based on earnings, there must be some extra risk. The pro tip here is to actually compare the earnings with the operational cash flow. And if the numbers don't add up, it might be that they are hiding something. The third problem is that almost half of all publicly traded companies are unprofitable. Without profit, the earnings are negative, and so the PE is unusable. Ignoring all these unprofitable companies, you might lose very good opportunities. After all, almost every company at some point in their life were unprofitable. Just think of Amazon or Tesla in the beginning. Just think about the pandemic when cruises and airlines drop. Imagine you have this kind of beast docked at the pier. Royal Caribbean in 2020 started losing money like crazy, and it went from $135 down to 19, minus 85% in 60 days. And it was a great opportunity, but P was negative, so we couldn't use it, and we would have lost it. Do you want to see where they went from that point? Check it out. $250, a staggering 1,236% in 5 years. So to recap, the three basic problems of the PE ratio are: 1. We know that earnings might be extremely high for some kind of extraordinary event, so we should always normalize the earnings. 2. We know that earnings are often falsified, so we have to take care of it. And 3, many companies are not profitable, and we can't use the PE in these cases. Now, let's be more practical. How can we use this PE ratio? One very powerful thing that we can do is to compare today's PE with the history of the PE of a certain company or an index. And this might give us some insights if the company is actually cheap or expensive. Let's check it out. So we can go on macrotrends.net, and we can see a ready search for Coca-Cola, and we can see here PE ratio, and we can see the stock price, earning per share, historical earning per share, and the PE ratio. And we can see that during 2010, 12, 13, the PE of Coca-Cola was around 13, 12, while today it gets around, is in the 20s, 26 today, 29, 25. It's definitely more expensive, almost double compared to the PE of 10 years ago. See here, there is this increase in earning per share that just go for 1 year. And here is exactly because they got some non-recurring event. You see, the PE was just 8. Was still a good bargain, but it should have been normalized because just 1 year later, the earning per share went from 273 back to 185. So it would have been more accurate to calculate it all the time around 180. And the PE, of course, went from 8 to 12. Now, the same math can be applied to indexes. For example, here on multiple.com, we can see historical SP500 PE ratio. And we have data since 1870, 150 years of data. And during basically more than 100 years, the PE went from 10 to 25, down to 5, 25, 5. And then in 2000, in the dot-com bubble, was the first time it basically surpassed 25, it went to 34, and of course it was a bubble, then it exploded. Today we are at 31.17. Now, I don't want to influence you, but I would say we have to be cautious here. I want to show you this other chart here, I found it on Reddit, is the US stock annualized real return over 10 years versus the PE ratio. So as we can see, the higher the PE gets, the lower the returns. For example, when the PE is below 10, this area here, there is a lot of green. It's incredibly green. And basically we can expect, in this area here, we can even expect a 15% on average real annualized return, so adjusted also by inflation. And in this other area here, I mean, yeah, over 40, it's just only red. Now we are 31, so here, I mean, yeah, we have to be cautious. So let's go back to the SP 500 PE ratio. Yeah, if you're wondering what are these very high peaks, like in 2002 or 2009, are of course the recessions. This happened because, as we can see here from the SP 500 earnings, when the earnings sharply go down, then of course by consequence the PE ratio skyrocket very high. The same happened to companies. We go back to Coke. We can see that in 2017, Coke reported just 0.29 cents of earning per share. And of course, the PE ratio went to 126. The price of the share didn't went down because, of course, investors knew that was just a year, and so they didn't sell off the company. But the PE ratio went very high. Thanks to Professor Aswath Damodaran, we can see the PE distribution of US companies. And in statistics, this is called a non-linear distribution, non-normal distribution. Usually companies are here around 8 to 12 PE, and this number then go down until 32 to 40, but then it goes up again, with a lot of companies over 100 PE. And these are exactly all that companies that gains pennies. It's important to remember that when we see numbers like this that are basically all over the places, we shouldn't use and focus on average, but we should actually use the median PE, which better represents the market. In the same presentation, Damodaran showed a PE recap of the US company currently traded, and as you can see, more than half, 56%, as of January 24, 56% have no PE because they have no earnings. Earnings were negative. The highest was 103,000 PE, and this of course increased the average that went to 121, and that's why we should instead consider the median. The median is like a normal company, is 15. So now that we know everything about the PE, only the most important question is missing. How can we use it to make money? The key of making money is to understand what's missing from the PE. That's actually very important to make a good investment. There are only two things missing from the PE. Just two. The mainstream recommendation is to apply the PE of all the company of the same sector. This is wrong in my opinion. However, like if you hear YouTuber or like read articles, that was always what they say. Apply every multiple to company of the same sector. Why they say that? Because if you take, for example, Coke, Pepsi, Dr. Pepper, Celsius, Monster, Red Bull, you calculate all the PE and you pick the one with the lowest PE. They think that in this way, taking the company on the same sector, they assume that they're growing more or less at the same speed. So growth is what is missing and is very important. Are the earnings growing or declining? And I mean, it's fundamentally clear now why it's fundamental, because imagine Coke could go back to the old good times of Pemberton and can spike back the drink with some cocaine, and I mean, super addictive, no? Next year, earnings will double. The year after will double again, and like this, a 26 PE will become a 6 PE. On the opposite side, if earnings are declining, let's take for example car companies like Fiat or Volkswagen. These are dinosaur companies. The PE is so low, 3.4 PE. It's crazy low. But no one wants their car anymore. Earnings are declining really quickly. We can see it here in financials, income statements, earnings from 16 to 12. Let's say we find a company with low PE. First things that we should ask is, okay, are earnings growing? Are they stable or are they declining? Growing? Perfect. How much? Now, predicting the future, it's always very hard, but there is a lot of research on growth. So for example, you can see the forecast of the analyst, or you can even ask ChatGPT to suggest it to you. Sorry, Chat, can you suggest me the average growth of the next 5 years of the earnings of Coke. Make it with 2 decimals. Thanks.
Based on historical trends and analyst projections, Coca-Cola's earnings are estimated to grow at an average rate of around 5.50% per year over the next 5 years.
Thank you. The second things to consider if you want to make money with PE, it's probably even more important, but it's actually even harder to forecast it right. Check this website, worldperatio.com. Here I reported the PE ratio of many countries, and you see who's on top: United States, New Zealand, India, because it's growing a lot, Swiss. Let's see who's at the bottom. Turkey, Greece, Colombia. Now they took it out, but before there was even Russia, it was even lower. Now, do you see where I'm going? These countries here are considered very safe. United States, Swiss, very safe country. This country here, Turkey, Colombia, Greece, very high risk. The PE ratio completely ignores risk, but that's a problem. Of course, owning a company in Swiss or US is not the same as owning a company in Turkey or Russia. But there are all sorts of risks. I don't want you to focus on geopolitical risk. There is all sorts of risk. For example, financial risk. Let's go back to Volkswagen. The price of the company is just 42 billion. However, with it, if you go into financials, balance sheet, total debt, 193 billion. So when you buy the company for 42 billion, you are also buying 193 billion of debt. I mean, do you want that? I don't. I mean, okay, the PE is just 3.4, but soon the banks might take over the company, or the shareholders will be asked to pay down the debt. But again, I don't want you to focus on debt, I don't want you to focus on the country. There are all sorts of risks. For example, might be legislation, sector-related risk, share dilutions, war, climate change, all sorts. But the main point here, one of the things that you have to remember is that PE doesn't include risk, but risk is very real and must be considered. Instead of comparing a company with other company of the same sector, it makes much more sense and will make you much more money to compare companies with similar growth and risk profiles. Ultimately, you want a company with low PE, high growth, low risk. If you can find this magic triad, then you have a winner. You can bet big, win big. And please, if you find that, let me know in the comments, because I want to buy it as well. So this is my first video. I put a lot of time and effort in order to do it. So it really hopes it helps you. Yeah, thank you for watching Other Economics. Peace out.